Stocktwits Nation, once again, this ridiculous video. Tom, I appreciated your moves. It's always a surprise what we're gonna get.
Yeah, I feel like I was set up. Max and Keith were like, "Hey, come on, be a recurring guest," and then we started this nightmare fuel that is, whatever this
You
intro
were kind
is.
of dirty dancing a little. Like it's getting edgier each
Oh yeah,
day.
Yeah.
I went through a sex change in the middle
I
of that video, I think.
I don't know. My outfits are changing. It's all good. Welcome to the Daily Rip Live. I'm Katy Perry here with Shay Boloor, as always, and we have Tom Bruni, editor-in-chief of Stocktwits, as a special guest today. Welcome, Tom. Hey, Shay. Lots going on. Lots happening.
Yeah.
We are again, like we were just in and out of news cycles, but the market is resilient. Market was kind of acting like World War III got canceled yesterday. Maybe it did, maybe it didn't. Then the headlines are all over the place, but we're staying focused on our long-term goals and portfolios, or if we're a trader, we're staying focused on our strategies. We had Trump yesterday dropping an F-bomb. I thought that was a historical moment. That was probably the most relatable he's ever been to me personally. I was
I
like,
mean, it's a permanent meme now.
yeah.
That clip right there.
But I'm like, you know what? It's fair. It's like a fair statement. I'm like, that's fine. And now the market is turning to more traditional drama. We had some earnings rolling in on the consumer side. Carnival Cruise Lines reporting yesterday, FedEx reporting. So a lot of things to cover today. Let's start with Carnival because they beat their Q2 estimates, raised guidance, hit record bookings. People love their cruises. This all happened 18 months ahead of schedule. So despite earlier tariff and travel concerns, their revenue was up 10% year over year. People are getting on the boats. FedEx beat Wall Street this quarter, but after hours had a bit of a rough time. They cut their full year 2026 guidance. Major reduction in Asia America lane shipping. No surprise there. And the stock was down about 5% after hours, 17% year to date. So people are spending, but shipping is showing a strain of macro uncertainty. We also had Uber and Waymo news out of Atlanta. Shay, I want to get your take on this one because I know you're following Tesla closely. Waymo's got this head start. They're in Atlanta. What can you say about the Waymo go-to-market strategy versus Tesla, or even their business models? How should people think about those? Because they're not the same, right?
Yeah, I mean, Tesla completely owns this whole stack, software, hardware. Waymo's not trying to tackle that way. I think Waymo's bet is you need LiDAR, and the way that Elon's trying to tackle autonomy, it's too much of a sci-fi dream. It's not going to become a reality. It's too difficult. We saw the first domino fall with that thesis over the weekend. That's why I caught a bid 10% on Monday. Faded a little yesterday. I think there's some noise on some government agencies wanting more information on the robotaxi event on Sunday. Like, I think people are picking too many holes onto what happened on Sunday. The big big reading on that was, guys, it happened. They were on the road. Yes, there might have been some tinkering on massaging the execution of that day. Let's just say that, but it proved that it can work and just needs more time, more data, whatever it might be. So now if you're thinking Waymo, the phrase is Waymo is BlackBerry, Tesla is Apple. Learn from the BlackBerry mistake. Maybe I don't know. BlackBerry still, even when the iPhone was going to get released, BlackBerry still did well initially. That adoption on the iPhones did not happen right off the gate. It was a slow build up. When it happened, it just blew up. So I think Waymo, it's not going to be a monopoly on autonomy. It's going to be a duopoly. I think that once Elon's vision scales up for autonomy, it's going to get trickier for Waymo's add value into that chain, because Tesla's autonomy version is a seventh of the price of a Waymo. Consumers in that industry, all they care about is convenience and pricing. That's something that's why Elon's tackling autonomy this way: cheaper cars, scalability. Waymo is not doing that because they didn't think that way was possible. So, in my opinion, Waymo probably has, if Elon succeeds at what he does, which I think he's going to eventually, Waymo's probably going to have to acquire some EV company. Rivian is an easy example. They have to try put the pieces together where they can bring that cost lower and lower so they can become more competitive, and then partner up with the Ubers of the world, because Elon does not partner up. He destroys industry. So maybe capitalize on that and partner up to create that second option. But yeah, I think Uber caught a major bid yesterday off that too. They're close to all-time highs, which is really funny because people think that Tesla's success is at the tax of Uber. Clearly, that's not the case at all. But yeah, it's a fast-moving industry with a lot of nuggets that you have to monitor to see how it progresses.
Yeah, it's funny you brought up Rivian to bring costs down because those cars are like $120,000. I've looked when I start adding things to it, and then I'm like, I don't need tires. I think I don't need that. But what you brought up was reminding me of a point Daniel Newman made last week when he was talking about SoFi and Robinhood, in that it doesn't necessarily need to be winner take all. Do you think you believe Tesla is more well positioned in the long term in a way that's a little different than like a SoFi Robinhood, or do you think that's a similar sort of situation?
Well, when we talked to Michael, which is like the oracle, I call him, because he's just been in the internet tech space for decades. Like, he mentioned how important it is to own the full stack. Like, it's really important to do that. Like, Google owns their full stack, their TP, like everything they do, they own it, their infrastructure. So I think that it provides a lot more optionality in the fast moving environments where if you own everything, you can pivot much more quickly. So for Rivian, for example, for Waymo, like acquire Rivian so you actually can own the cost more instead of going through, I think Jaguar is like their primary source.
Mhm.
I also think that NVIDIA is going to also accelerate the autonomous industry as well. So like maybe Waymo is just buying more time because they know that what NVIDIA is going to do for a lot of these OEMs is going to essentially build up a lot of their companies and products to become more autonomous through their chips, that there's going to be more options out there to bring their costs down. Like it's so early, but I also, again, like when we talked about Monday, it was yesterday morning because we ran out of time on Monday. It was a great story, first domino falling, but like we're a ways away from any kind of fundamental bump on autonomy for Tesla. And I'm a big Elon fanboy, a big Tesla bull, top 10 position, but I'm nowhere close to adding because I know it's a long journey ahead. It's a tall mountain. I think we're going to get above it, climb above it, but it's a ways to go still.
Yeah. It's funny you brought up Waymo. They're talking about Waymo in New York, and everyone's like, how is this going to work? Because New Yorkers don't follow rules or don't walk in straight paths for like all terrain, but we'll see. Tom, I want to kick it over to you because I know you have a fun thesis you want to explore around this topic of boomer stocks. And I love this as a concept. I feel like we talk a lot about really exciting AI and cybersecurity, but there are these like lame stocks that just rip. And let's go into some of your picks there and what you're seeing.
Yeah, so I mean, these aren't necessarily picks. These are just things that kind of intrigue me from a technical perspective. I'm looking at take General Mills this morning. They reported earnings, basically cut their earnings guidance again, said, hey, costs are rising. We're not able to raise prices and offset kind of what we're seeing on the cost side. And so we're going to have to eat that. And so they cut their earnings guidance, they cut their sales forecast. What is a traditionally defensive stock is down 40-50% from its highs just a year and a half ago. And so I'm kind of like interested by these, boomer-esque stocks that people see as like safe havens, when if you look at the actual fundamentals, stocks like General Mills, Pepsi, et cetera, are facing major headwinds right now. So a lot of people are moving towards these names as to protect their portfolio in the event of war or other kind of like things that cause money to flow out of cyclical stocks. But we're actually seeing the opposite. These stocks are suffering more because what's happening in the world, what's happening with tariffs, and consumer demand is impacting them more than some of the technology stocks that we've been talking about. So I just find it interesting, like if you're playing these defensive stocks and they have no pricing power in this environment, they have to eat the costs. And I think this will have impact on the overall economy as well in terms of the job market, because if you're General Mills, right, you can't raise prices. You've got cost pressure. Where do you cut? Headcount. So I do think there's an AI component here where on the corporate side of General Mills, on the efficiency side, they're going to try to do more to kind of reduce costs where they can, and weather the storm until they can get to a point where consumer demand rebounds or they're able to raise prices again.
Yeah, it's when you brought up reducing costs, P&G just announced they're going to lay off 7,000 people in the next 2 years. And a
Yeah.
lot of them are on the corporate side. So it'd be interesting to see how General Mills follows that. General Mills also just announced they're getting rid of the red dyes. I don't think that was why the stock went down, but is there anything particular in the General Mills story that or a theme that you see across other stocks, or what are some of the other examples that you're looking at of stocks that are seemingly not too risky and that are struggling right now, or perhaps outperforming?
Yeah, sure. So I think a quintessential example of like a boomer stock going through a transformation over the last 18 months is IBM. I mean, that stock did basically nothing for 20, 25 years. Had this huge run up until the tech bubble, it was up thousands of percents. And then, the fundamentals had to catch up to the business. So it took 20 plus years for those fundamentals to catch up to the stock price. Prices went basically nowhere. And then in November 2023, we reached kind of this inflection point where they became another AI tech player. And they got caught up in this narrative, and the stock's been making new all-time highs basically every month since that inflection point. So a couple others that I'm curious about are like, Intel. The stock has not made a ton of progress, but it stopped going down. And as a technician, that intrigues me because, in order for a trend to reverse, it has to slow down and stop first. And so I think Intel's at an interesting point between, 17, 18 bucks is the recent lows, and then 25 is the recent highs, where we're stuck in this range. And I feel like buyers and sellers are trying to digest and really understand, what the next move here is for Intel. And, I'm not a fundamental guy. So, Shay, maybe you can jump in here. I find it hard to believe that a large US chip maker like Intel is not going to have some sort of role in this AI revolution. I don't know what it looks like. Maybe they're sold for parts. Maybe they, get rid of their foundry business, whatever it is. But I'm looking at this technically and saying, hey, it's at the same level it was 25, 30 years ago. Maybe there's value here. So I think that's a conversation a lot of people are having right now is this a value or is this a value trap? So Shay, what are your thoughts on Intel?
Yeah, I mean, I think everyone wants Intel to work. I think
Yeah.
their new CEO is doing what he needs to do to trim the fat, trim the dying part of their business, reallocate their soldiers towards what's going to be necessary for them to grow. That takes time, especially for a company like Intel. So I don't think it's going to happen this year. Probably won't even happen next year, to be honest. Their customers they're trying Foundry. They're trying to make Foundry succeed. Customers are not adopting it. Like there's not, because there's a difference in conception and adoption. Like conceptually, they're trying to make Foundry work. It's hitting specific scores, but customers still aren't adopting it. That's the big tell. And I think that's machine learning and AI is very difficult enough. Like why go for the second fiddle or a turnaround story when TSM, yes, their demand is insane and there's a backlog, but you need their chips for you to succeed in machine learning and AI, and you just don't want to risk that part of the stack because of whatever like savings or whatever reason, like you want to go through Intel. So I think as soon as you see a major hyperscaler adopt them, not test them because Amazon's testing them already, but actually adopt and be a customer, I don't think you touch the stock until that's the first sign. And I hope so, because if it's the American AI vision, like I think Trump wants Intel to succeed. I think he wants us to have a domestic foundry. Doesn't matter if TSM opens up an Arizona plant, like they're still going to be it's not going to be the latest and greatest TSM chip that's going to be open domestically. They're going to save it all on the east side of the world. that sucks. Like, I think the US wants the best, latest and greatest domestically, and even if TSM opens a plant, it won't ever provide the latest and greatest chip for us.
Yeah, I think, like you said, it takes time. For me,
Mm-hmm.
it feels like all of the components are there. We just don't have that clear catalyst to kind of shift the narrative just yet. For me, as like a technician, if we can, how we resolve this price range for the last 6, 8, 10 months is going to determine the next kind of phase for Intel. If we get above 25, the top of this range decisively, that's probably coinciding with some sort of news that is better than the current narrative it expects. Like maybe it's not a major customer, maybe it's cost cutting, maybe it's some incremental margin improvement, whatever it is. But I just know for these types of turnaround stories, it doesn't take a lot to get things going, especially when so many people are offsides. And so I think Intel is super interesting. There's a lot of technical and fundamental aspects that can go right here, but as you said, I think people have kind of left it for dead because there's so many other stocks that are working right now. Like, why play catch up if you can own the leader that continues to make new highs every day?
Well,
Um,
also, you bring up a good point though. Like, everything is running right now. That's been proven a winner.
yeah,
I don't like chasing. So I like to invest when there's blood in the water. There's a disconnect between a narrative and actual business execution. So right now, what I've been adding the past 1 or 2 months are definitely the riskier sides of my portfolio, the ones that have a broken story or the
mhm,
market thinks the thesis is cracking. So I'm not chasing Robinhood here. I'm not chasing Palantir. I'm not chasing like CrowdStrike at 500. Like, these are names that are proving they're winners, and the market's rewarding them as leaders of this rally. But the opportunities right now are in the names with a broken story, and there's risk involved in that. But I like to build positions before the market realizes what this position is, and you see a run rather than FOMO chasing it. But that's like Intel fits that category. Like, Intel is probably a name that if you believe in that story, that turnaround story, even if it's the next 2 years, this is the time you build that position up before the market sees them turning around and it
yeah.
runs.
Yeah.
All right. So it sounds like I'm getting I'm convincing you a
I
little.
was
We'll
gonna
see
say,
maybe next week.
Shy, is this gonna go in the portfolio?
Uh,
Considering in the consideration set.
it's a little too mature for me as a
Yeah.
turnaround story. I'm a very growth element component. Like, for me, like right now, my broken stories are MongoDB, Unity, Global E, DigitalOcean. Like, these are all companies under 10 billion that I think have a pathway to 25 to 50 billion in the near
Yeah.
term. But I'm part of like, do I just raise a 20% cash position right now and wait for like a Robinhood to break below 50 again, or wait for Aklo to get in the teens again? Like, those are names like uh I want exposure in,
Yeah.
and I just
Yeah.
like, who
Robinhood
knows
just
what's
hit
gonna
an
happen? Yeah,
all-time high, right? Yes.
$85. Yeah,
Yeah.
they're
Yeah,
gonna hit 100.
Coinbase is playing catch up too. Spotify just hit a new all-time high. Like, the winners are winning, to Shai's
Mhm.
point. So at this point, like if you're not already involved, how do you manage risk in a way that you can get involved and still, not lose your shirt on the pullback that will eventually come.
Yeah,
Um,
pullbacks always come, guys. Like, it doesn't, like, right now I'm getting a lot of feedback from my subscribers. Like, do I get in this? Do I chase this? Should I get this? Like, no, like, there's always going to be 3 to 4 pullbacks a year. Like, for some weird reason, there's going to be a 5% correction sometime before the next year, before the end of this year. There's going to be some FUD headline. There's going to be some black swan event. Like, wait for that. Build the conviction. Do the research so you have the conviction to add when everyone's screaming blood in the water. That's the time, like, when you actually should do the work. So I think you don't chase. You be patient. Enjoy the sun for the summer. I don't know if, like, we're gonna get pullback this summer. We're in a pain trade right now, and pain trades don't really change until there's liquidity in the market, and there's no liquidity during summer months, low volume. So, like, it's one of those weird times where just sit on the sidelines, build the conviction, do the work, enjoy the sun. I think August is going to be a very tricky month. I don't think we're getting a Fed cuts in September like a lot of people anticipate, and I think maybe that's the opportunity of a pullback. But the sentiment's crazy right now. It's very tilted on one side.
Yeah, it
yeah.
feels, I mean, if it feels like if there wasn't a pullback now, it's like, what is that going to be? And maybe it's not a geopolitical thing and it's something else. Our big boss Howard shared out yesterday that he sold some stuff, So he got out of Robinhood, making some gains, Coinbase. And he's talking about, as he always does, the degen economy. And he was talking specifically about some news yesterday on Polymarket raising $200 million. So that's the prediction market casino exchange. Kalshi is a partnership with Robinhood. I live in New York. We were all watching the mayoral race yesterday, and every news outlet was citing the Polymarket odds. And it was weird because it's usually when you follow this stuff, it's like exit polls or it's like, no, they just had the real time Polymarket chart up. And it was pretty damn accurate to what happened. So he's predicting there'll be more companies like that spinning out of VCs. I don't know how much room in the public markets there are for prediction market platforms. Do either of you have a hot take on how big that could be? How many players could own that space?
I mean, I think Polymarket has an early mover advantage. Predictive market is a new industry. It's very, very infant in the component of like having funds in it, how legal it could be, the federal legality of it's complex. But for me, when I like all this geopolitical headlines, like Twitter is a cesspool on like what's real, what's not real. So when I see a headline, my first reaction is let me go on Polymarket, see if there's a bump on specific odds. That's my truth now. That is very real and it's going to be accelerating in the future on being a component of every investor trader's process is checking a predictive market to see if this is noise or an actual signal. So I think that industry is very real.
Yeah.
I think you seeing Robinhood create a predictive like market ish very fairly quickly is a little scary in my opinion. It's probably my thesis on why I don't like DraftKings. I don't think there's a high barrier of entry for competition and degeneracy on gambling. I just think it's very easy once you have an ecosystem, a brand, etc. Because the customers, you heard me say this, Katie, like degenerates have no loyalty, so they just go for the best bang for their buck
I
type of
want the
thing.
sign-on bonus. Give me $100 so I can
exactly.
I'm going to
Yeah.
use that one on my enemies. Someone wrongs me, I'm be like, degenerates have no loyalty. Neither do you.
Yeah, I mean, that's why Robinhood makes so much sense because my funds are there already. It's so
Yeah.
seamless for me. DraftKings,
Yeah.
like when I lose my DraftKings money, like back when I was a degenerate in my early 20s, it sucked having to refund my accounts. Like it was like a gut ego check of like, I lost again, and now I have to like go transfer money from my account, and it's like a reminder of loser, loser, loser. Where like Robinhood's there already. I'm not gonna feel like as much of a loser.
Yeah.
Yeah, I agree. I tend to think like long term there will be, in the early stages there will be a lot of companies that try to do it, but then ultimately we will get consolidation and it's involved in the overall financial stack of a Robinhood or a SoFi or whatever. The other piece is like maybe there's a Coinbase element to this where there is, whoever masters the regulatory environment for this first will be kind of the immediate winner. I think this, there's still a lot of uncertainty around, the regulatory side of this and what that's going to look like. And so I think, obviously Polymarket, what is that the one that's like US regulated or is it?
I think
That's
Kalshi is.
Kalshi, but Polymarket has the I don't know if it's exclusive, but the big Twitter X partnership, which is huge because like X uses
yeah. So I think for if we're talking about a US consumer, US market share, it's going to be whoever can master the regulatory side and play nice with, the legislators. So yeah, it seems like maybe Kalshi will be the winner there in the US market. And then Robinhood, obviously, they're building out, everything they need to kind of get this involved as another product for their customer base. So yeah, it should be interesting.
Yeah, it's just wild to see how quickly. I'm like, I think Polymarket killed like polling post or even pre. I'm curious, like it's even the legitimacy of people referencing the data. I forget what institution it was, but somebody had screenshotted yesterday on X. It was like a Morgan Stanley or a Goldman in a report like referencing Polymarket trends. And so you're seeing more and more of that. I want to stick on degenerate economy for a bit because there was some big news in the BNPL space that came out. So prior to this news update, the BNPL providers, your Klarnas, Affirms, Afterpays, they were not reporting to the credit bureaus when people are late on their payments. And it was always seen as this like, it's kind of credit, but it's kind of not. Well, they're going to start doing that in the fall. So a lot of people are saying, wow, a lot of people are going to be in for a rude awakening with their credit scores. There's been a lot of data. People are behind on their payments. Affirm released some data that said 80% of their users would be unaffected. I think Tom, before the show, you brought up a good point. That's the total individual users, but like of the people who are really in default, like how bad is it? Do you think? I'll start with you, Tom. Do you think legitimizing the BNPLs is like making them report? Does that help them in the long term, or do you think this just blurs the line between BNPL and credit, and people are just going to go back to using credit with their normal, banking tools?
Yeah, I think the immediate effect will be now that there's some sort of consequence to using it outside of, the instant regret of seeing, the bill that you have to pay is if you're not paying it and it impacts your credit score, you'll be more cognizant of like how you use it and when you use it. And I do think that 20% of people who are heavy users or maybe having uh, trouble paying or are just saying, hey, there's no consequence, so I'm not going to pay. Like those are some of the most active users of these. And so I do think in the short term, maybe these companies will see a hit in terms of their overall volumes and number of customers using it. Long term, um, I think legitimizing it like this and getting it more ingrained in the financial system is probably a positive for these companies because it allows them to then again expand into other credit forms and not just be a one trick pony. The other component to this is it all comes down to convenience as well. As long as they can continue to be a main option in people's cart and at the point of sale, they will still have some version of market share because it's just easier. If I can, if I'm paying 25% interest on a credit card or I'm paying, something comparable for a BNPL loan, I'm going to use whatever is most convenient at that point. So if I can click one button and just get this thing delivered and it's through, Klarna or Affirm instead of, my bank's credit card, then I'll probably do that. So I think there's an element of convenience here, but yeah, in the short term, I think this will probably have some negative impacts on usage for that group of people who have been having issues paying their bills.
Yeah, it'll be interesting. We have a Firmal report later in the summer, and that's going to be interesting because we'll have some pre-data at least. TBD if that actually changes anyone's behavior until it's reported. Shy, you've kind of dogged BNPL in the past. What do you make of this? What do you make of this news? Do you think this hurts these players like Affirm, others? Klarna is on the sideline waiting to go public, so timing for them kind of sucks. What do you make of all this?
I mean, I don't think any of those companies will be around in 10 years. I think buy now, pay later is it's an unfortunate part of the ecosystem, financial ecosystem. I think because my thesis is unemployment will get to 15%. I think AI is going to really disrupt a lot of blue collar and white collar workers. And I know a lot of people who think about making a $1,000 purchase with the mentality of, oh, it's just $25 a month. Like I can easily do that. Those things build up over time if you have that mentality over the course of 2 years, 1 or 2 years, and then all of a sudden you have a pretty big commitment on a monthly basis on these BNPLs.
Yeah.
So as soon as you get that income, top line income removed, and you have these buy now pay later payments, you have your rent, you have your insurance, all that stuff. Like you're just that's something that's going to break your back a bit, and I think that's so I just don't think those companies will exist anymore because I think by now it's going to be breaking the system because I think unemployment will get to 15% sometime next 10 years, unfortunately. And it's something it does worry me. It prevents me from like being aggressive with buying a house. It
Yeah.
prevents me from being aggressive with that because I do think there's going to be a pretty ugly like great financial crisis next 10 years due to all these fast moving cycles.
Yeah, I think housing sales are worse they've been in many, many years. That was, of course, the opening bell. Things relatively unchanged. We were, of course, talking about BNPLs. on trending down, as are BBLs. So all the BBM, BBL, all those things are just falling out of favor. Apparently, headline I just spotted: Bumble stock is up 15%. And I was like, oh, what'd they do? They cut a third of their workforce. So just as you were talking, Shy, it's about 240 people. It's not a big company. Dating apps in general, difficult terrain for these companies now. I think you hear anecdotally a lot of people are frustrated with the experience. They got Match.com was buying up companies left and right, but the market likes the cost cutting measure. Let's turn to something else I spotted, which was, I guess we're back on the topic of boomer stocks. Winnebago, which actually is more like an actual boomer stock and not like the boomer stock in your definition, Tom.
Yeah.
Their RV sales were down this quarter. They reported earnings, but their boat sales are up. So I did not know this until last year. They own Chris Craft and I think another pontoon company. And so the discretionary spending is slowing in some areas. And in other areas, premium segments, boating, rich people like their boats, doing pretty well. Interesting, Winnebago also bought a lithium battery company last year called Lithonics. So that's one of those companies that's like more than meets the eye. It turns out that I looked into it, and camping is as popular as it ever was. It boomed after COVID. But I think this is about the data we see where people with wealth are spending more, and the discretionary spending among other groups of people is down. So, do either of you guys have a boat?
I don't, and I will never get one because it's a money pit. But yeah, I think the true story here is sure, discretionary spending is down across the board, especially for middle and lower income consumers. But the true story is where people are spending money. We started the show talking about Carnival Cruise Lines. People are spending on experiences. They're not spending on goods like boats or RVs in this case. That's a trend we've seen since the pandemic. People are it started as revenge spending because you've been locked in your house, so you want to go on trips, you want to get out of the house, you want to experience life again. And that trend has continued for much of the last 2 to 3 years. And so we're seeing hotel stocks, airlines for a bit were doing well. Anything that's related to experiences, restaurants doing well. Texas
Yeah.
Roadhouse is like a stock that goes up every
I
day.
love
So
Texas Roadhouse.
yeah,
That's the one where
so
they throw the peanuts on the ground, right? You can
I
eat the
think
peanuts
so.
and throw the
Yeah.
shells on the ground.
Yeah. I
It's
think it's
amazing.
that one, or they also have like the buttery rolls that people
Yes.
like at the beginning. So yeah, they
Yes.
got the full package there. But my point is, like, we're seeing this theme continue, whether it be Winnebago or even FedEx versus Carnival Cruise Lines, right? Like FedEx, there's fewer goods being shipped. People are buying less junk, and so you're seeing that in FedEx, you're seeing that in UPS, you're seeing that in Winnebago, but they're still spending money. It's just them spending it differently. I
Yeah.
think the true story for the market is like when we get to a point where people cut spending across the board, when they're no longer buying goods and no longer buying services or experiences. That's going to be kind of the straw that breaks the camel's back. What gets us there, I don't really know. I still think the labor market, the initial jobless claims number is the most important number to watch. If we start to see a material uptick in companies laying off people and saying, hey, we've been doing more with fewer people. We're hiring less. If they go from hiring less to reducing their workforce,
Yeah.
that has a massive impact across the board, because if you lose your job, what are you doing? You're not spending on goods and services. Maybe you're having trouble making your housing payment. Like, there are a lot of trickle down effects there. And so I think these are good reads from Winnebago and Carnival on the current state of the consumer, but I feel like that could change very quickly, if we get a material uptick in unemployment.
Yeah, it's also interesting to think about the types of jobs being impacted. Like we've talked about before, some of these white collar jobs, well-paying jobs, what specific companies that impacts versus others. I mean, you might see it across the whole spectrum. But if Microsoft's cutting thousands of people in Seattle, it's a
Yeah.
they're different things they're using in the day to day. So, Shy, I think on on this, do you have any thoughts on just like experiences as part of a thesis, or is that something, I know it's not in your core 5, starting 5, but do you think the experience economy will continue to grow, or do you think that there's risk there of some pullback?
I think there's definitely some risk in the pullback. I think naturally, psychologically, people feel like they're in a better financial spot than they truly are because, unfortunately, of credits or buy now, pay later, etc. Eventually, when things get bad, institutions tighten up, giving you loans, all that stuff. So I think I wouldn't be a part of those experiences right now, but I also think that's going to change pretty drastically as well. Like I think right now, I think every industry is going to change so aggressively and so quickly due to AI. I guess AI
Mhm.
bull talking about AI all the time, but you guys have no idea. Like AI is intelligence. Intelligence touches every industry. It's going to change, and it's going to be more efficient. It's going to be automated. It's going to be great for consumers, but like I think it's going to change the experience. Like why would I think what was an example like Airbnb, for example, like
Yeah.
I think that's a semi-broken system. I've never been bullish on Airbnb because I'm just not that customer. I don't get it. Why overpay when
You
you have
don't
to
want to
clean up
clean the
after
shower
yourself?
when you
Yeah,
leave.
yeah, yeah. It
I'm
just
not
doesn't
doing the
make sense to
laundry.
me. So that's an epitome of experience. I also think that autonomy is going to change experiences as well. Like you just don't know uh like what's going to be connected into like I don't know. I think that whole industry is going to change. I also think that like the boating thing, I'm also not that dumb. Like my fiance's dad used to be a yacht captain, and I get really
Sick.
bad vertigo. So like one of my first experiences with him going on a boat, I was just like in the corners, like
Oh,
not social at all. I was like not doing well, and I could see the masculinity, respect in his eyes
oh my
diminish right off
god.
the gate. I was like, "This is a
Oh,
new modern man,"
oh
and
my
I was like, "No, he
god.
doesn't get it." But no, I going off your also like the workforce again. I mean, my my future brother-in-law, like he works on boats, and I'm emphasizing to him like he's really young, he's 22, like you need to change industries. Like you need to pick something that won't get replaced with automation or won't get replaced by this like trend we're going towards. I do think that people it's for the experiences, it's escapism. That's why
Yeah.
people like movies do movie industry does really well during like, really bad times because people want to escape. That's the cheapest form of escape. That was pre-streaming. Now you can escapism via streaming. But I think all these geopolitical headlines, like it makes people want to kind of do something to forget about it or distract yourself.
Yeah.
That can
Uh,
only go so far though.
yeah. I mean, as you were talking, I was looking up Live Nation because Tom, when you were describing people, like that's one, but I think it depends which company in which space because Airbnb's
Yeah.
down a little bit this year. Live Nation, duopoly, monopoly, I don't know. Is there whatever they don't have much competition and people are going to concerts and there's more concerts than ever before. Um, so
Yeah.
even within that, right, there's people who are more set up for success. Tom, you're
Yeah,
saying.
and I think going back to the Airbnb story, like if you look at Hilton Worldwide HLT, like that stock's at all-time highs. So the usage is there. People are using Airbnb and hotel chains and travel companies, but the economics of the business model really do matter. Like if you're an airline, right, you have so many factors to manage other than just people getting on your planes. And so yes, they're seeing record volumes of people traveling, but they're not seeing record profits because there's so many other factors. And so
Mhm.
I think it's important to recognize the wholesale trend and say, okay, great, people are spending on experiences, but then you really have to look under the hood and say, which companies are positioned best to win financially in the event that they get an influx of customers. Even Carnival versus Royal Caribbean, Carnival Cruise Lines is still down. It peaked in 2018 at 71 bucks. It's trading at $25. Royal Caribbean is at a new all-time high today at $281,
Wow.
and at the pandemic low, it was 20 bucks. So
Whoa.
similar, same industry. They do the same exact thing, but vastly different businesses under the surface. And so I think that's a key point that people need to understand is you can have a core thesis, but how you choose to play that thesis really matters. And we see it play out in stuff
So
like Carnival versus Royal Caribbean.
as you were talking, I realized what I was missing. I was like, I have a reason why I'm bearish on the experience industry, and you made me think about what it was. Hilton, Airbnbs, etc. How much is that correlated with business travel, T&E? If I think unemployment is going to rise to the mid-teens, those are the industries that are going to have a massive headwind because, especially the Hiltons of the world, there's going to be less people traveling for work. And I also
Yeah.
do believe AR and VR is eventually going to hit a point where it's going to be very big in the B2B space. Like we already got the glimpses of in COVID on Zoom, etc. Like once everyone scales and adopts Meta's like kind of products, Apple's products, Vision Pro, like you're going to be in an AR VR experience in businesses now. So like they're going to be less willing to like fly you physically out in IRL to these locations because these AR and VRs are going to be so realistic and it's going to do the trick already for you that maybe you have to go for the big deals like handshake in person, but for the majority of them, you won't have to anymore. That's why I'm bearish on experiences. It's more on the business side, which I think I don't know what the stat is, but I'm sure it's a heavy component of the experience industry's business travel.
Airlines, it's huge.
Huge.
Yeah,
I think
it depends on the company for sure, but it is a huge component. And like Shy, if you're talking about unemployment, rising to 10 or 15%,
Yeah.
like then it's a double whammy, right? Like companies are not going to send you to travel because there's other options and because they don't want the costs. And then people, don't have discretionary income to be traveling. So that would kind of be Armageddon for these types of
Mhm.
travel related or experience companies.
Well,
So
and also like this is the first time in like stock market history, in my opinion, that we have like 4 super cycles happening at the same time, like quantum space, AI, electrification. Like, why are you guys investing in these like hotel chains or experience chains? Like these are dinosaur industries that are going to get disruptive, maybe in a positive way, maybe not, but it's why expose your capital towards that? I get that you think everything's expensive in these like secular growth themes, fine.
Yeah.
Google's trading at under 20 times earnings. I don't know what these other companies are, but like that's undervalued in my opinion. That's not going away anytime soon.
And was it Royal Caribbean that was $20 in COVID? That sounds pretty good. It's a casual 10 bagger.
20 to 280. Even pre-pandemic, it peaked at 140, so it's still a double since then. So there are opportunities. Not everything has to be like even if Shy is right over a 10-year period, there are going to be time frames within that period where these stocks perform very well if you identify.
You're still holding Royal Caribbean after COVID, though. God bless you. You probably forgot your password. You should log in. Royal Caribbean, though, not likely to be impacted by business travel. I think we should do more business travel on Royal Caribbeans, though. Shy, you wouldn't be able to go, but
yeah, I'd be down. I'm
Why
not a
not?
huge fan of cruises because I just find there's not a ton to do other than eat and just like
Drink.
drink.
You're
and,
trapped. You're
all that
trapped on the cruise.
stuff.
I don't understand the luxury in that. Like,
I've
it doesn't
never
make
been
sense
on
to me.
one. Never been on one.
I've heard great things about the Alaska cruise. Like everyone's always
Oh.
like, if you do one cruise, it has to be the Alaska one. Like
I get that one.
for some reason. So
The glacier,
I think
it's
that's
beautiful.
Cool.
Yeah.
Yeah, exactly. You don't have to get off and go see the glacier. You can see it from the ship. So maybe that one.
I mean, also like my fiance loves boats clearly because her dad was a yacht captain. I sometimes have Larry David like experiences in public, and she knows that. So like she does not want me to be trapped in the place with someone that I just riffed with really bad, and like I'm going to see them constantly. That's another fear of just like being. I just don't see. I don't get it. Like
you're getting recognized too, Shy. There's nowhere for you to run on the boat. You're gonna have to hide in the below deck.
Yeah, they'll see me double fisting like the ice cream cones, and they'll be like, "Is that editor in chief of Stocktwits? Like, what is he doing here?"
We should do that. So it's Stocktoberfest. If you guys don't know, is coming up this fall, and maybe next year we could do it on a boat. Tom, I wanted to flip back to another company you had pointed out in our notes here, and that was UPS. What is going on with UPS? It's interesting. I feel like I never see those guys around anymore. They have much cuter outfits than the FedEx people or the Amazon. But I don't know. There's fewer of them. Like maybe it's just where I'm at. But what's going on with UPS? Because we know with FedEx reported. What are you seeing with those guys at the moment?
Yeah, I got to dig into the fundamentals here, but this was another interesting one from a technical perspective. It's at a key kind of like inflection point from the last 2 decades. This $85-$90 price range has been, a transition point for buyers and sellers. And so when I see something like this, I want to dig in and say, okay, what's the current narrative? What could change potentially? For me as a technician, I love having a clearly defined risk level. And so if I'm saying, hey, the stock's at $100 now, worst case, if I need to get out, if it breaks this level at 85, my risk is 15, maybe $20. And if they can make some small changes to their business that change the narrative, well, then there's potential for it to revisit its all-time highs eventually. So, to me, I look, 15, $20 worth of downside, $150 worth of upside if you're patient. This is the type of opportunity that I would look at and say, okay, if I own, 50% of my portfolio in the total stock market index, VTI, maybe valuations are worrying me. Maybe I have too much tech exposure, replacing a portion of that kind of broad-based market exposure with kind of this turnaround story that will take many quarters, many years to develop, but has the potential to 10x over the next 3, 5, 10 years. Like that is a good opportunity for you to not wholesale like change your whole portfolio, but instead of being 50% VTI, maybe you do 45% and then add 5% in FedEx or UPS, because you're still getting that beta exposure to the market. You've got a turnaround story that offers a potential return higher than 8 to 10% that you're expected with the broader S&P or the broader market index. And so again, I think we covered this earlier in terms of like turnaround stories, inflection points, things like that. Obviously, FedEx outlined a lot of headwinds here, and UPS has underperformed FedEx since the pandemic. So clearly, there are additional challenges here that that the market is sniffing out and believes in. But when I see something like this, it gets me interested to dive a bit deeper. So maybe I can look into this one, and by next week, maybe I'll report back that I've replaced some of my broader market exposure with UPS or Intel. Because
Yeah.
I'm getting close. I'll be honest.
Oh, okay. That's a good you could do what Shay does and tweet out a mysterious tweet. I'm going to be adding something and then forget to update people.
Nice. I mean, that's why you got to be subscribed, right?
You gotta
get that
gate
notifications.
that revenue streams. I just spotted a headline that ties to something we were just talking about. I feel like on Monday with Michael, NATO agreeing to to raise the defense budget, so 2% to 5% of GDP. That's across the NATO alliance by 2035. This is something our guest Michael Park was pointing out on Monday, where you say people are rearming, they're arming up. So Shay, this seems like a good signal for your defense bucket.
Yeah, I mean, it's again, the defense spent $1 trillion last year. You just heard that revision on the upside on what they're going to allocate more towards. That's only going to accelerate. Again, it's the threats are evolving pretty quickly. It's not something you can see in person. It's going to be things that you can't see: cybersecurity, cloud, AI, drones. Above, like these are the new threats, and I think there's a lot of early disruptors in that space that have a ton of runway. And the beauty of like, I get this all the time, like, oh, Palantir is worth more than Lockheed Martin or around there. Like, what's their upside case? You're talking a hardware based defense versus software. The scalability on the software is unmatched versus hardware. Like hardware, there was always going to be a ceiling on how much they can be worth because it's just so heavily capex. There's no recurring nature to it as much as like the software component. So if the defense budget is evolving, it's going to be getting bigger and bigger. Software is going to be a massive component of that. That's coming at 80% margins and a ton of runway. And in my opinion, unlimited spend, because yes, we got close to World War III recently. That fear is never going to go away. I do think eventually there's going to be something where the world's going to pick two sides. It might just be Russia, China, and Iran, and everyone else. That eventually could happen. But either way, like you have to be prepared in that world and reality, and the way to do so is the Palantirs, the cybersecurities like CrowdStrikes, uh, these new age defense buckets that I love. And when you find an early disruptor who has a moat and a runway as big as the new age defense, all they have to do is execute in their business, and the TAM or total addressable market will just carry it with it. So that 1 trillion, that could turn into 1.5 by the end of this decade. And by then, if this new age of defense gets even 10% of that, we're talking $150 billion allocated towards the new age of defense. That's huge. And that's only going to scale up and scale up. And the Lockheed Martins of the world, the old defense, like they can't do what these new age defense people can do. It's not that simple. So it's pretty disruptive.
Do you
And
think
I
like
think
the Lockheeds have to do some M&A to keep up, or do you follow them at all in terms of how they're planning to compete with the Andurils and some of these other guys?
Well, I don't follow them, but I know that it's very it's unfair, I guess, what the government, the relationships they have and the lobbying.
Mhm.
Like I
Yeah.
think maybe once we get like the more generations into the decision making in government, that maybe those relationships will go away. But the government's definitely carrying all those companies. Like
Yeah.
it's if they didn't have them, they'd be screwed for sure.
It goes back to something one of my former bosses posted on LinkedIn, of all places, but talking about how the jobs that in the past that seemed like guarantees, like P&G, I'm going to get a job at P&G, I'm going to ratchet up the ranks, I'm going to be there 20 years, I'm going to get my pension. Same thing if you're like a Lockheed with the government. Like all those jobs are like somehow becoming the most risky to have right now. And that's a big shift, I think, that we haven't seen. So that's going to be interesting to watch too, especially as you point out, Tom, we get more employment data in. We are nearing the end of the hour, but I want to ask you both, it's midweek. What's on your mind? I guess it's the summer, so it's weird to say things are chill because I feel like every other day something insane happens.
Yeah, there's
And
no chill whatsoever.
but like we just roll with it. Like it's fun. Like I have friends texting me from like other states. And they're like, "Oh my god, what's going on in New York?" And I'm like, "I don't know. Mind your business. No one cares."
We're all
what-
melting.
yeah, it's hot. I don't know. Is there something else going on? No one likes Cuomo. Tom, what are you looking at? Like, especially like, you run an entire editorial team. What are your writers, contributors? What's the community saying? What are some of the headlines we should be watching as we round out the week?
Yeah, I mean, we're at quarter end basically, so there's going to be some window dressing, people, kicking the losers out of their portfolios and all that, especially after a major run. I think the big conversation happening right now is similar to what Shay mentioned before. A lot of people are sitting on big winners that are up, 30, 50, 100% off the April lows. The major averages are up 20, 25% from their lows. And so we've seen this kind of global risk on behavior with, international stocks, Bitcoin, crypto in general, surging over the last 10 to 12 weeks. And so people are kind of using this quarter end as an opportunity to rebalance and say, okay, if I have some big gains, I see some risks on the horizon. How do I rebalance? How do I make my portfolio a bit more defensive? So far, that thinking hasn't been right. I mean, the market continues to trudge higher. But I think the key thing to watch is not necessarily the news, but the way the market responds to the news. The market has taken everything the world has thrown at it. Powell, Trump, Middle East tensions and war. And yet every day we're finding new reasons to go higher. So I think it's important to recognize the type of environment you're in and when the inflection point happens. Right now, we're in an environment where the market is interpreting any news as good. It doesn't matter what it is; they will find a positive spin to it.
Yeah.
At other times during April, right? The first quarter, it didn't matter what you said that was positive. There was a negative spin to it, and the market traded lower on it. And so I think we're still in this environment where people are looking on the bright side. Institutions are still allocating capital toward these risk-on assets, and so that's why I brought up some of these kind of catch-up plays, because people are saying, "Hey, I recognize that the market is still strong. That the bulls are in control here for now. but I don't want to pay up for a Robinhood that's up 100% in
Mm,
the last, 12 months or 6 months.
yeah.
So they're looking for other opportunities. And I think Intel and some of the others that we discussed are, on people's radars. I don't know if they necessarily got there, but yeah,
I
we'll
love
keep an
it.
eye on those.
Pick someone off the waiver wire, It's that time.
Exactly.
Shy, final thoughts from you before we depart our lovely viewers for today.
Yeah, the power of retail. I have to say, I mean, when I was hearing Tom talk about it, it's been the scoreboard the past couple of years. Retail bought the dip. Institutions had to pay the premium once they were offsides on that dip. I think people are asking like, who's buying pounds here at the 140s? Who's buying Robin in the 80s? It's the institutions. It's window dressing. You're paying a fat fee for these whales to take care of your funds. Once the quarter's up, you're seeing like, okay, why are you not owning these names when these Joe Schmoes are in their mom's basements on FinTwit posting about it and they're outperforming you and buying it? Like, why am I paying you those fees? It doesn't make sense. That's what window dressing is. They're going to have to allocate those funds towards those winners. And essentially, it's like extra juice that they get at the end of the quarter so they can like put the lipstick on top of their underperformance of, we own those names too. Like, we still see those visions. That's what the institutional catch up is. That's why the climate is changing rapidly, where retail isn't dumb money anymore. Institutions aren't smart money anymore. It's much more democratized. Information is a lot more diverse where you can get it everywhere. And that's why retail has more of a chance now to compete against these institutional whales. And you're seeing them just scoreboards 4-0 in the past 2 or 3 years. And you can make the argument, oh, it's up to the right. We had the quickest bear market on, I don't know, on record, but in a while, just a couple months ago.
Yeah, it
That's
was
a
the
gut check.
third fastest recovery in history.
And who
Yeah.
was buying it? Yeah.
Retail.
Who's
And
retail?
institutions
Yeah.
were fleeing April 7th. April 5th. Where was the bottom? April 7th. Same
Yep.
thing happened. Another yen carry trade crisis that happened last year. Like, these are not one-offs anymore. They're a trend. So I think that's the power of retail is very real. I think we have a voice and it's multiplying, and there is going to be, it's only scaling up. We're going to have a much bigger and bigger component of the stock market now. And I love to see it. And you can call it frothy. I think it's frothy right now, but retail isn't the reason it's frothy right now. Institutions are playing catch up, and that's causing the frothiness. And they have trillions of dollars on the sideline. That's why I think this pain trade has legs in the summer months, because those trillions of dollars of sideline, they have to be allocated towards the winners, or they're not going to have those trillions of dollars going forward, because people are like, I don't need you guys anymore. I'm going to go elsewhere.
I mean, you heard it here first. If you are a publicly traded company, you should be talking to your retail investors. You should come on our show, come hang out with us. I'm talking to you, Andrew at Hams. I've been trying to DM you at you. Maybe I'll clip
People buy
this.
stories. People buy
Yeah,
stories. They
you
don't
gotta
buy.
come talk to the people, and sometimes the people are leading the bigger fish. And I think a lot of companies are realizing that. You see Robinhood's out there with retail investors, Tesla inviting retail investors to their event. So we will continue to be here to serve you guys as retail investors. Tom, thank you so much for swinging by. You'll have to come back and let
Yeah,
us know
thanks for
how
having
General
me.
Mills is going. Shay,
Yeah.
good to see you as always. We'll be back tomorrow at 9 a.m. Eastern time, and we'll see you next time.
Awesome, guys. Take care.